Cash is a pretty important asset to any company, so companies have to learn how to manage and protect it. In Chapter 7, we'll look at a few methods that businesses use to do this. When we refer to cash, we're not just talking about currency or coins or what we keep in our pocket. Cash can also be checks made out to the business. Typically, when a customer pays us, they'll pay us by check. We could be referring to money orders, cashier checks, or amounts that we have on deposit at other financial institutions. Like we said earlier, cash is one of the most precious assets that a business has, and everybody would like to get their hands on it, and it can be really easily taken and mishandled if it isn't protected. One way that we can take care of our cash and other assets is by using internal control. Internal controls are just policies and procedures that a business uses to ensure proper accounting. So a good system of internal control will safeguard assets, ensure the accuracy of the accounting records to ensure that no mistakes are made, promote operational efficiency, and to comply with laws and regulations. One important internal control is establishing responsibility. So you only want properly designated personnel to handle cash receipts. An example of that is in the banking or financial industry. All the cashiers have their own cash box, and only that cashier has a key to it. So if there's anything missing, there is only one person who can be responsible for that. Another way is with separation of duties. So that means that the person who accounts for the cash is different from the person who receives and deposits the cash, and the duty of reconciling the bank statement should be done by a person who is not responsible for receiving, accounting, or depositing the cash. There's also physical protection of the cash. So your cash should not be lying around, and it should be deposited daily depending on the amount. If you're collecting a large amount of cash, it probably needs to be deposited more than once daily. And then there should be documentation of the cash receipts using cash register tapes or a receipt of some sort. When a bank account is opened, a signature card is created, and the information for the account is listed, and then there is a place here for those who are allowed to sign on the account. And it can actually be more than one person. Sometimes companies will say, well, if it's a check over $5,000, it will need 2 signatures, and all that would be indicated on the signature card. And the bank keeps this information on file so that they can identify forgeries. When a deposit is made, a deposit ticket is filled out, and it's a form that shows a detailed listing of the items being deposited. The currency, coins, and checks are all listed separately, and the text tells us that each check should be identified by its ABA number. And I really don't know any companies who do that. The ABA number is the number in the top right-hand corner of the check. So if a customer gives you a check, you'll see it looks like a fraction up in the top right-hand corner, something like this. But to me, this does not really provide a lot of information. I would put the name of the customer who gave us the check here, and that's a much better source document to me. But the text says to list them by their ABA number. Notice we have a box here for currency, a box for coins, and an area where we can list our checks. And sometimes if we collect a lot of checks, you can use more than one deposit slip. Before being deposited, checks have to be endorsed. So that just authorizes payment of the check by the payee. And if a company receives a lot of checks, like an apartment complex, for example, they may use a signature stamp instead of having to handwrite every single endorsement on the back of the check. If you've ever deposited a check, you know that it has to have a signature of some sort on the back before it can be deposited. If a signature stamp is used, it's very important to keep that safeguarded. And the endorsement just transfers ownership of the check to the bank. You can also transfer it to another individual. There are different types of endorsements. There is the restrictive endorsement, which specifies the purpose of the deposit. For example, for deposit only, and then the signature of the person the check is made out to. So only one thing can be done with this check. It can only be deposited. A full endorsement specifies who the check will be paid to. It would say, paid to the order of Robert Sterling, and then signed by the payee, who is Kathy Nash. So Kathy is authorizing that this check be transferred to Robert Sterling. And then there's the blank endorsement. So if Kathy just signs the back of her check, then anyone bearing this check can go cash it legally. So if she loses it on the way to the bank and somebody finds it, legally they can cash it. Most businesses use a check to pay all their bills because it leaves a paper trail. But once in a while, it might be necessary to use an ATM or a debit card. And I think we're all familiar with that. So every depositor has a plastic card, which is either an ATM or a debit card, with an identification number or a PIN number. If one of these is used to pay a bill or make a purchase, it's really important to keep your receipt or paperwork as a backup so that the payment or purchase can be properly accounted for. When we write a check, we are ordering or directing the bank to pay a sum of money to a specific person. There are some terms that you'll see on your quiz. The person who writes the check is called the drawer. The bank on which the check is written is called the drawee, and the person to whom the check is made payable is called the payee. So the drawer is the owner of the account, the drawee is always the bank, and the payee is the person who will be receiving the funds. There are 3 steps in preparing a check. Now, I know these checks really well. Some of our younger students might not be so familiar with the check, but it's important that you know how the check writing process works, because that is how bills are paid and purchases are made in a business. First, the check stub is completed in the register. And check stubs include the amount of the check, the purpose of the check, the previous balance, the current balance, and any deposits that were made. So the check stubs are like a check register, if you're familiar with the check register. So step 2 is to enter the date, the payee's name or who we wrote the check to, and then the amount on the check. And the third step is, of course, to sign the check, because checks are no good unless they're signed by the drawer. Here's what a business check looks like. Here's the stub. Okay, and first thing we'll do is enter the date, who we're writing the check to, and what it was for. So the accounting department will take this stub and then enter it into the accounting records. The account that's going to be used is rent expense. So we previously had a balance of $36.25.41. This check was $300, so now our new balance is $33.25.41. Now notice on this stub, in the middle of the month sometime, there was an amount deposited that was listed here. And this way we can keep a current balance of what is in our checking account. It's really important to do that because you never want to overdraw your account. And of course, here's the check itself. Once it's written, it's torn off here. The company keeps the stub. We've entered the date and the payee and the amount, and then notice the amount is written out in words. And if the words and the amount do not disagree, the bank will go by what's written in the wording. And then here's the signature of the drawer. And we could enter here the more information about the bill we're paying, like the account number, if we needed to. At the end of every month, a company will receive a bank statement, and the bank statement shows what the company started with, all the deposits that were made, all the checks that were written, of course any service charges that the bank charged, to result in an ending balance. So it is important that the balance that the bank is showing here is the same as the balance in on our check stubs and also in our general ledger. So what's on the bank statement should equal what's on the check stubs, which should equal what is in the general ledger. So to do that, to ensure that, we're going to reconcile the bank statement. When you first look at your bank statement ending balance and then look at your book balance, which is your check stub or your general ledger, you're probably not going to have the same balance. So we're going to have to make some adjustments. There are going to be differences there due to maybe some errors that were made or just some timing differences. Now here are some reasons that our balances aren't matching. The first one is outstanding checks. If we write a check, we go ahead and deduct the amount of the check from our checking account balance. Well, it takes a few days for that check to clear the bank. So if we receive the bank statement and the check has not cleared, that check's considered outstanding and the bank has not subtracted it from our account balance yet. So we've subtracted the check, the bank has not. Deposits in transit are about the same. If we make a deposit, say on January 31st, maybe at 4 o'clock, late in the afternoon, we go ahead and add that to our checking account balance. Well, the bank may not process that deposit until February 1st, so the deposit won't be showing up on the bank, so they haven't added it to their balance yet, but we've already added it to our checking account balance. Another reason is for service charges. We won't know our service charge until we get our bank statement. So we will not have subtracted service charges and other fees from our checking account, but the bank already has. And then there are errors. We might have written a check down incorrectly or had some incorrect math on our check stubs, and we'll find that when we look and compare what we have on our stubs to our bank statement transactions. Sometimes the bank makes collections for the company. If a company has someone who owes them a note or a big accounts receivable, sometimes they'll just direct them directly to the bank and ask them to make their deposit, and the bank will collect for them. If that happens, sometimes those amounts have not been added to our checking account, but have been added to the bank statement. And then there are NSF checks. Those are insufficient funds checks. Now, these are not checks that the company wrote. We're referring to checks that customers gave us. We added to our deposit and added to our checking account balance, but the bank subtracted it because the check was no good. So when we're completing our bank reconciliation, these are the types of things we're going to be looking for to adjust our balances with. Oh, and here's one more. The unrecorded ATM or debit card withdrawals. Remember, we said earlier you need to make sure that you account for those, but sometimes they don't get accounted for. So we'll find those when we examine our bank statement sometimes. In this slide, we'll look a little more closely at timing differences, and this is the one related to deposits, or in other words, the deposit in transit. Remember, that's a deposit that we've entered on our books that has not appeared on our statement. On April 30th, we have made a deposit for $600, and we entered that on our books on April 30th as one of our April transactions. The bank does not post that deposit until May. So here we have this deposit on our April books, and then the bank has it on our May statement. So we are going to be a little short on our bank statement balance by $600. Now let's look at a timing difference related to cash payments, the outstanding check. So the outstanding check is very similar to the deposit in transit. It's a check that is on our April books, but not on our April bank statement because it took it a few days for it to clear the bank. They clear a lot more quickly than they used to, but still it may take a couple days. So they have not decreased our balance by $350 where we have, so that check will not show up until May's bank statement. So all we're going to do is make a little adjustment for those. The first thing that you do to reconcile your bank statement, and when you're working in accounting, you are going to have to know how to reconcile a bank statement. It's just a skill that employers will expect you to know how to do when you walk in the door. So if you don't understand it, make sure and let me know. We need for you to understand it by the time we get through with this chapter. The first step is to compare the bank statement with your books. So we're going to take our books and look at all of our deposits for a month. And then we're going to take our bank statement and compare those deposits. So the deposit on our books should match every deposit on our bank statement. If there is a deposit listed in our accounting records that is not on the bank statement, we'll consider that a deposit in transit, but it should be around the end of the month. If you had a deposit that you made at the beginning or in the middle of the month and it hasn't cleared, that's a little unusual. But if there's one around the end of the month, it should show up on the next month's bank statement. You could find an error in the amount, and that would most certainly need to be investigated. If you've entered one amount on your books and a lower amount cleared the bank, you would definitely need to investigate why that happened. But we also need to make a correction in our accounting records. Step 2, we're going to do the same thing with our checks. We're going to look at all the checks that are listed on our books and compare them to the checks that cleared the bank. So if there are any checks that we've written that did not clear the bank, we consider those outstanding checks, and those would be subtracted from our bank reconciliation, or subtracted from the bank balance on the bank reconciliation. Then in step 3, we're going to look for any additional reconciling items. Usually banks love to really apply a lot of service charges to business accounts. So more than likely, you will certainly have a service charge that's been deducted from your bank balance that needs to be deducted from your checkbook. You will look for errors in deposits or with checks and investigate those, and then make adjustments on the books for any errors. Look for bank collections, which would be considered a credit memo if the bank collected an accounts receivable or a notes receivable for you. Any NSF checks, these would need to be deducted from your checkbook balance, because we thought that the check that the customer gave us was a good check, but it turned out to be a bad check, and the bank rejected that check. So we would have to make an adjustment in our checkbook for that. We would make adjustments for unrecorded ATM or debit card withdrawals, and those can be easily found by just comparing any withdrawals that you've got on your checkbook to those on the bank statement. If you're lucky, you may earn interest on your account. So if that's the case, then you would want to add the interest back to your checkbook, because the bank has added a little interest to your account. And then there might be some other reconciling items like debit memos. If you rent a safe deposit box every year, the bank will deduct $40 or $50 out of your account for it. So you'll need to look for those types of entries also. Now here is an example of a bank reconciliation. So I'm going to just go through the steps with you. The first thing that I typically do is find the bank statement balance. So notice this one's dated November 21st. You can cut it off at any point. Banks sometimes will report on the 20th or the 25th, or actually the last day of the month. But whatever the last date that is on the bank statement, you'll list it here and just put the amount over here. Drop a few lines and then enter your book balance. You can enter the balance for November 21st the same as the bank, or you can do it at the end of the month. I typically would do it at the end of the month. And then you start with your adjustments. So you compare your checkbook with the bank statement and then add any deposits in transit. So in this case, we had one deposit that was made toward the end of the month that we have on our checkbook that is not on the bank statement, because the bank did not post it yet. They probably posted it on the next month's statement. Then look for outstanding checks. Compare your check numbers and amounts to those that cleared the bank. And if you have checks on your books that did not clear the bank, then you list them separately. It's important that we list these all separately so we can identify them, because for next month we're going to be looking for this deposit, and we're also going to be looking for these checks to clear. So we've listed them here on the left and put the total on the right. So notice we've added deposits in transit and subtracted outstanding checks to get our adjusted bank balance. Okay, these are the only two adjustments made to the bank balance. You add deposits in transit, subtract outstanding checks, and that is it. Any other adjustment goes down here to the book balance. So let's look. We've got an error. Okay, here is a check that was written down in our checkbook for more than it cleared the bank for. So since it cleared the bank for less than what we subtracted, we are going to have to add 90 cents to our book balance to get it to agree with the bank statement balance. Here we've got an unrecorded ATM, and so the bank had already deducted this $100, so we're going to have to now deduct it from our checking account balance. We've got an NSF, an insufficient check, that a customer gave us for $200 that we had added to our checkbook balance. So we're now going to have to subtract this $200, and then we have a bank service charge of $1.80 that the bank has already deducted that we now need to deduct from our books. Now that we have our adjustments, we'll start with our ending book balance, add the 90 cents for the error, subtract the 100 for the unrecorded ATM, the 200 for the NSF check, and the $1.80 for the bank charges, and we'll end up with an adjusted book balance of $2,092.33, which matches our adjusted bank balance. So we have reconciled the bank statement, but we still have work to do. All these adjustments here have to be entered with a journal entry to update our accounting records. Now, we don't have to make any adjustments to the bank statement. The bank statement just has the timing errors up here. This deposit will clear next month. These 3 checks will clear next month, most likely. So nothing needs to be done to the timing differences. We only have to make adjustments to our book balance. So it's always a good idea to find your book balance and then add or subtract one adjustment at a time with your journal entry. So the first adjustment here is an error on check 214, and we need to make a journal entry to add 90 cents to our check stub balance and our general ledger. So to do that, to add to cash, we debit it. So we know one side of our journal entry will be a debit to cash. Now the credit is to whatever the check was written for. In this case, it was for a payment on account, so that's the reason we credited accounts payable. If the error had been written for rent, we would credit rent expense. So the textbook or the problem will have to give you an indication of what the error was made on, and in this case it was a payment on account. So always your offsetting account from cash will be whatever the payment was for. Let's go back and pick up that second entry now. We had an unrecorded ATM withdrawal, and that is a deduction from our checkbook or general ledger balance. To deduct from cash, we credit cash, so we know that that's one side of our entry already. Okay, so we've credited cash, and most often if there's been a withdrawal out of the company's cash account, it's likely going to be the owner's withdrawal. So just assume, unless the book tells you different, that if there's an unrecorded ATM withdrawal, that the owner made it and he withdrew money for his own personal use. So here's the cash to reduce the balance, and here's the debit to drawing to record the owner's withdrawal in that account. Let's look at the third entry here. We had an NSF check. So we collected this check that was not a good check, and now we need to deduct the $200 for the check out of our account. So once again, we're deducting, so we're going to credit cash. Now let's go and look and see what that debit will be for. When an NSF check is paid to us, we debited cash and then we credited accounts receivable from the customer. Well, now we're going to debit accounts receivable when we have to deduct this cash again. We're going to put them back in our accounts receivable so that we will remember that this specific customer owes us $200 for a bad check that they gave us. So anytime you have an unrecorded NSF check, of course you're going to be crediting cash to deduct it from cash, and then always debit accounts receivable. Now let's look at our last adjustment was for a bank service charge. It was a $1.80 deduction. So since this was a deduction, we're once again going to credit cash with our journal entry and debit miscellaneous expense. So some companies will keep a specific account for bank charges, but our textbook is instructing us to put it in miscellaneous expense. So for all bank fees and service charges, credit cash and debit miscellaneous expense. So once these 4 entries are journalized and then posted to the general ledger, the general ledger account is brought up to date. We're also going to have to take those adjustments and enter them on our checkbook balance so that account will be brought up to date. If we fail to make the corrections, then our bank reconciliation is going to be off by these amounts again the next month. So it's very important that these adjustments are entered in the general ledger and in our checkbook. Since there's quite a bit of information in this chapter, we'll go ahead and work some of the problems after each section. So now we'll take maybe what we learned and is fresh on our mind and apply it to the bank reconciliation process. So we'll start with exercise 7.4. And just to review, remember when we are reconciling our bank statement, there are 2 adjustments to the bank balance. We add deposits in transit and subtract out outstanding checks. All other adjustments are adjusted to the book balance, and you can usually use your common sense to decide whether to add or subtract from your book balance. But let's look at these adjustments here. First, we have deposits in transit to the bank. So we are supposed to indicate whether it is adjusted to the bank balance or the book balance, and whether it is an addition or a deduction. So we just said that deposits in transit are always added to the bank balance. That's one of the 2 adjustments that are applied to the bank balance. Deposits in transit and outstanding checks. Okay, so we are going to find that it is an addition to the ending bank balance. On number 2, we have an error in the checkbook. Now, that is not a deposit in transit or an outstanding check, so we know it's an adjustment to the book balance. But on errors, you really have to think carefully about how that error goes. Think about, did you subtract too much from your checkbook, or did you not subtract enough? So it says the check was recorded for $32, but it cleared for $23. So we have subtracted too much from our checkbook. So we need to add the $9 back to our checkbook balance. So we are going to add to the book balance. The service fee charged by the bank, see, the bank already has that recorded, so this is going to be an adjustment to our books. It's not one of the 2 adjustments made to the bank balance. So service fees, of course, are a charge to the company, so it's going to be a deduction from our book balance. Outstanding checks are one of the 2. Remember, the deposits in transit, outstanding checks are adjusted to the bank balance. It's a check, so it'll be deducted. So a deduction from the bank balance. An NSF check that is a check that was given to us that we've added to our checkbook that is not any good. So we're going to have to subtract that from our book balance. Here we've got another error. We know that errors are always adjusted to the book balance, but let's look and see if we add or subtract. The check was recorded for $22, but it cleared the bank for $220. So we've got a $198 difference here. We only deducted $22. We need to deduct $198 more because it cleared the bank for $220. We left off a zero when we recorded that in the checkbook. So we're going to go to our book balance and deduct that $198. And then we've got a bank credit memo where they are advising us that they collected a note for us. So the bank already knows about it. We're going to adjust this to our books and we're going to add it to the ending balance. Now let's go down and complete a bank reconciliation with the adjusting entries. Okay, in this problem 7-8, we have the book balance in the checking account for Johnson Enterprises of $57.18. Now we're given this, but if you're sitting in the office, you've got to go to your checkbook balance and look at the end of October and see what your balance is. Then we have the bank statement that came in the mail, and it is showing an ending balance of $52.17. And when the books and the bank statement were compared, these were the differences found. So first step is to get these balances in. So the book balance is always entered toward the bottom. So let's see. Here we go. The book balance is already listed out there for us at $57.18. Okay, and then we have the bank statement balance is $52.17. Obviously, those are not the same, so we need some reconciling. All right, first we have the deposits in transit. We have compared the deposits in our checkbook to the bank statement, and everything matched except for these two toward the end of the month. So these two need to be listed as deposits in transit. Deposits in transit are one of the two adjustments listed on the bank statement balance. So we'll come down and find our bank statement balance and add the deposits in transit. They're deposits, so deposits are added. So on October 29th, we had a deposit of $210. And on October 30th, we had a deposit of $406. Okay, and that totals $616. So now we'll go ahead and add that to our ending bank balance, and we'll come up with $58.33. Now we have the outstanding checks listed here, and we got these figures by comparing the checkbook for October with the checks that cleared for October on the bank statement. All the checks cleared except for these four. So these are outstanding checks. So we're going to come down and now list these separately as outstanding checks. So going to come down and deduct. Checks are deducted. So check 1635 was for $56.40. Check 1624 was for $175. Oh, that says error. Sorry, that's check 1639. And then check 1641 is $135.50. and then check 1653 was for $443.10. Okay, and those will total $810. And we'll subtract that from the $58.33 from above, and our adjusted bank balance is $5,023. Now we need to make sure our book balance is adjusted to $5,023. We have an unrecorded ATM withdrawal of $200. That's a deduction. Service fees are a deduction. We have an NSF check that's a deduction. So now let's look at this error. The checkbook shows it was for $75, but it was actually for $57. So that is an $18 difference. Now I deducted from the checkbook $75. I should have only deducted $57, so I need to add the $18 back. So we'll come down and add the error of $18. So we have now a balance of $57.36. We have some more adjustments. We have a deduction for $237 and an NSF check for $476. So we're going to deduct the unrecorded ATM. I think that was $200. Then we're going to deduct the bank service charge, and that was $37. And then we're going to deduct the NSF check, and that was $476. So our deductions total $713. We'll deduct that from the $57.36, and our adjusted book balance is $5,023. So the adjusted bank balance and the adjusted book balance are the same. Now it's time to enter the journal entries that result from this bank reconciliation. Remember, I don't need to do anything with the bank statement adjustments. Those are timing differences and will take care of themselves. What we need to worry about is anything that was adjusted for the books. So we'll start with the error on check 1624. And remember, it's important that we know what this error was on, and it says accounts payable was debited in this original transaction. So we're going to come down here, and since we are adding to our cash $18, we need to debit cash, because a debit increases cash. So we'll take the cash and enter the $18. And it's told us that we had originally credited accounts payable, so that is going to be the account we need to correct. So our offsetting account there will be the $18 to a credit to accounts payable. Now let's look and see what our next entry needs to be. The next adjustment is a deduction for an unrecorded ATM withdrawal. And we did have a note up here regarding that ATM withdrawal. It says funds were withdrawn by Enoch Johnson for personal use. So we know that the offset to this journal entry will be to drawing. So we have a deduction here to deduct from cash. You credit cash. That's how cash is lowered. So we'll lower cash by $200, and then we'll offset that with a debit to drawing for $200. The next adjustment is for a bank service charge for $37. It is a deduction, so that means cash needs to be credited. So we'll credit cash for, was it 18? $37. And we are going to enter that as miscellaneous expense for $37. So all bank fees and charges will be debited to miscellaneous expense. And then we have our NSF check. It was a deduction for $476. So that means cash needs to go down by $476. And the debit is going into accounts receivable because we have to put this customer into accounts receivable because they gave us a bad check, and we need to make sure we try to collect on this bad check. That concludes the bank reconciliations section. So now we'll go back over and begin the petty cash fund section. In a business, it's not always feasible to write a check for every small expense that comes along. So companies will set up a petty cash fund on the premises that will help take care of the small expenditures. First, the company has to establish a petty cash fund. So once it's established, it's always there. But if a company does not have a petty cash fund and wishes to have one, it has to be set up. So first, they decide how much cash they're going to keep in the fund. Are they going to keep $100, $200, $250? And then they write a check for cash that is cashed at the bank, and then the cash is brought back to the company and kept in the petty cash box or the petty cash drawer, and someone is placed in charge of those funds. When the petty cash fund is established, a check is written, as you remember, and the journal entry for that check is debit petty cash and credit cash for the amount that is going to be established. This entry is made only one time because the fund is just established one time. So this is the only time you will debit petty cash. It will stay on the books at $100. Now the petty cash cashier, who is the only person who has access to that cash, will fill out a voucher every time cash is requested. So the voucher is going to show the details of the payment, and it's also going to serve as proof of the payment. So when we look at that, we'll see an example of a voucher. This is voucher 2, and on December 8th, James Maple asked for $25.75 for a client luncheon. And Tina, who is the petty cash cashier, approved it and gave him the money. So now Tina is going to enter this voucher on the petty cash payments record. Now she's not going to make a journal entry for it yet. She's just going to keep up with her cash outlays on the petty cash payments record. It's not a formal accounting statement. It's really just a record to help Tina remember how much she's given out and how much she has left in the fund. Here's an example of a petty cash payments record. The total in this example is $75. So on the second it says the fund was established, and sometimes the 75 will be written out there to the side. And then on the third, $15 was given out for office supplies. So that was voucher 1, the amount was $15, and it was for office supplies. On the 5th, postage due is the reason that voucher 2 was filled out. The amount was $1.27, and it was for postage expense. So you put the amount in the total amount column and then spread that amount over under the correct account name. Down here, if you'll notice, on the 12th, the owner asked for $10. So she gave out the $10, and it was for the owner's drawing. It was personal use, and we don't have a drawing account here, so she put it under other. Kathy Nash drawing, and then the $10. So she's going to keep up with all her petty cash payments, and if you notice here at the end of the month, she has spent $68.84 out of $75. So she only has $6.16 remaining in the fund. So now it's time to replenish the fund, and she's going to use this petty cash payments record to replenish it because she knows where she spent the $68.84. Now, some companies replenish the fund only when needed, and some companies will just replenish it monthly. It just depends on the company. So definitely when the funds start running low, then it's time to replenish it. When we say we're going to replenish the fund, we're just going to replace the amount that we've spent, and to do that, we're going to write a check. Okay, so here are the totals that we got from the petty cash payments record. We are going to debit all these expenses in our replenishing entry because this is the only way those petty cash expenses are going to get on our books is with this replenishing entry. So we will debit office supplies expense, miscellaneous postage, drawing, and advertising, and credit cash for $68.85. Okay, so the replenishing entry will look like this. And notice that we're not debiting or crediting petty cash again. We only did that within the establishing entry. This is where we're going to write a check for cash, and then the petty cash cashier will go to the bank and cash the check, and then bring the funds back and add it to the $16 or the $6 I think and 16 cents that she had left to bring the fund back up to $75. So there are only two journal entries that you need to be familiar with for the petty cash section: the establishing entry and the replenishing entry. So now we'll work one of the petty cash problems. It said on January 1st, a check was written in the amount of $300 to establish a petty cash fund. During January, the following vouchers were written for cash and removed from the petty cash drawer. Okay, let's establish the petty cash fund first. Okay, remember, the establishing entry is only done one time, and to do that, we debit petty cash and credit cash. We're writing a check for $300. We're going to cash it and bring it back to the office and place it in the petty cash drawer. Now, during the month of January, phone expense was paid out of the petty cash fund, auto expense, drawing, postage, charitable contribution expense, and miscellaneous. So if we add that up, we have spent $228.10. So it's time to replenish the fund. To do that, we're going to debit all of these accounts. So the first one will be phone, automobile, drawing, postage expense, charitable contribution expense, and miscellaneous expense. And we'll enter the amounts. Okay, and these are all expenses, so they're going to be debited. Now we're going to write another check for cash for the amount of our expenditures. So we'll add up all these debits and the total that we spent should be $228.10. I wanted to make sure my math was correct. So remember, the only time petty cash is debited or credited is we're debiting it here in the establishing entry. When we replenish, we're going to debit where the money was spent and then credit cash so that we can cash this check and bring it back. So we have $71.90 left in the fund. So we're going to bring that back, and it'll bring our fund balance back up to $300. We'll now review the last section in Chapter 7, and it covers the change fund and accounting for cash shortages and overages. And it deals primarily with working with the cash register in the retail setting. So if you've ever worked in the retail setting and worked the cash register, you know that when you open the drawer, first thing, there is a change fund in there because you have to have change to make for your customers who pay in cash. If that change fund is not already established, then you have to set that change fund up. So we do that by writing a check because we're going to cash that check and we're going to get so many 20s, so many 10s, so many 5s, so many 1s, and then coins that will add up to the amount of our check, and we'll put it in the drawer, and that'll be our change fund. And we'll never take that back to the bank. We're just going to keep it in there so we'll always have change for our customers. But to set it up initially, you just debit change fund and credit cash. It's a lot like establishing the petty cash fund, except we're establishing a change fund this time. Okay, so we have a business that decides to establish a change fund for $125. So we've debited change fund $125 and credited cash $125. Someone will take this check to the bank, get it cashed, and then bring it back and put it in the cash register. Now let's look at how we account for the day-to-day sales and collections of cash. Sometimes a cash shortage is going to result in our cash register when it is we have less cash in there than our cash register tells us we should have. So at the end of the day, the sales are totaled on the cash register, and then whoever works that cash register counts the amount of cash in the register, and hopefully it's going to equal the amount that the cash register said should be in there. But sometimes there is a shortage, or there could be an overage, because when you have a lot of transactions, sometimes you just make mistakes, hopefully small mistakes. Sometimes people can't help themselves and they borrow from the cash register, and that is also a way to detect if there's cash missing from the register. So we're going to take a look at our cash register tape and then count our cash, and we'll either have a shortage or an overage, and we need to record that in the accounting records. So when we complete our journal entry, if there is a shortage or an overage, we're going to put it in the cash short and over account. Now if there's a shortage, there will be a debit balance, which is, all our expenses are normal balances. So if we end up with a debit in cash short and over, that'll be like an expense to our company, an extra expense. If we have at the end of the week or the end of the day a credit balance in our cash short and over account, it's like a revenue. Revenues are credits, and when we report the cash short and over on our income statement, if we have a debit balance, it'll be listed with the expenses. If we have a credit balance, it will be listed with the revenues. All right, assume that cash in the cash register amounts to $598, And based on the cash register tape, we should have had $600 in there. So you can see we've got a $2 error. So this is how you prepare the journal entry for this day's cash register receipts. In sales revenue, we're going to put the amount on the register tape because that is the amount that we actually earned for that day. We're going to enter cash for the amount of cash that we counted in our cash register because that's what we'll be depositing in the bank at the end of the day. There's a $2 difference, so we're going to plug in a $2 debit here in cash shorten over to make this debit side equal with the credit side. We do have a shortage, so it should be entered as a debit. In this example, we have $774 in the cash register, and then on our cash register tape, we have $769. So remember, the tape is the amount that goes in the revenue account, or the sales account in this case. The amount of cash that was in the register is the amount that we're taking to the bank, so it's going to be debited to cash. So I typically will put those figures in first. So I will find the sales revenue and enter it as a credit of $769. I'll enter the cash as a debit of $774. And then I know that I've got to plug this cash shorten over either on the debit side or the credit side. Well, the credit side in this case is the lower of the two amounts, so that $5 difference has got to go over here on the credit side. Previously, we had $600 and $598. We had a shortage, so we had to put it on the debit side to balance. Here we've got an overage. It's going over on the credit side to balance. So let's look at this example. Cash sales based on the cash register tape amounted to $592. Cash in the cash register drawer was $692. There is a $100 change fund. Okay, so remember, we're not going to take our $100 change fund to the bank. It was already in there when we started our day. So we are going to subtract $100 from the cash register drawer. So the cash that we're going to debit is going to be $592. And then we're going to credit our sales for $595. So we're actually short $3. So we're going to debit cash shorten over for this $3. Now let's put that to practice. We're going to work exercise 7-7 here. Here is the weeks in April and the amounts on the cash register receipt and the actual cash counted. Now our instructions tell us that we have a change fund of $100, which means we have to remember that that is included in our actual cash counted. So let's work now on getting these journalized correctly. All right, first of all, we want to enter our cash as the debit because we're taking that to the bank and we're going to increase our cash account by our deposit. Now we're not going to deposit the entire $366.50. We're going to hold out that $100 change fund and just leave it in there for the next day. So we are taking $266.50 to the bank. Now I'm going to skip down to the last line and enter the amount of revenue. So the service fees, in this case, is the name of the revenue. I'm going to enter $268.50. Now that is a $2 difference. I need $2 here on the debit side to get this to balance. So cash shorten over will be a debit of $2. So just make sure that your journal entry balances before you go to the next entry. And it looks like here we're going to have a $2 shortage because the cash is less than what the cash register says we should have. Then on the 9th, we had $333.50 with the $100 change fund. So my cash will be $233.50 that I'm taking to the bank. And then the revenue, service fees, will be recorded at whatever was on the tape. So that's $237.75. That is a difference of $4.25. So once again, our cash is less than our revenue. So we are going to enter the $4.75 on the debit side and enter cash shorten over. On this one, we have $4.11 in our cash drawer on the 16th, and we'll leave $100, so the cash will be $3.11. The revenue is $309.25 according to the tape, and I'm not sure which line they want me to put that on. I like to put it on the last line anyway. Service fees will be $309.25, and so we have a difference there of $1.75. So this time cash shorten over has to go on the credit side to balance for $1.75. So we are over this time. We shorted some of our customers some change of $1.75. On the 23rd, we had $324 in the cash drawer, and 100 of it is for the change fund. So I'm going to enter $224. The revenue, I'm going to enter in the revenue account at $226.50. The difference there is $2.50. It's got to go here on the debit side to balance, and of course that goes in cash shorten over. On the 30th, we had $422 in the cash drawer. I'm going to subtract that $100 change fund and enter $322. And then $318 is going in the revenue account. That's a difference of $4. It has to go on the credit side to make the journal entry balance out with debits and credits. So cash shorten over is getting a credit of $4 this time. So once again, we've shorted our customers some change. And after checking, clicking check my work, I see I have a math error up here. That should be $425 and not $475.